Alright guys, I hope you're doing great. We want to take a look now at the markets very quickly, so it's a brief update and there are certain things I want to discuss. Okay, so first of all, I have opened here the DXY, so this is the dollar index, and this chart looks very interesting to me. So I'm looking at the 3-month time frame as well as the 1 month. We will look at that also briefly, and we can observe some stabilizing going on here with this green candle, which is not finished of course because this is a 3-month period, so we need to wait until the second quarter for that one to close. But we can go down in the monthly time frame, and also here you can observe that a green candle has formed. And so therefore the question is whether the DXY is stabilizing at current levels. We can see here there is horizontal support as well as Fibonacci support here with the 50 and 60. So we actually could come down a little bit more if we would want to and then go up again. And so in terms of Elliott wave, this looks like a ABC corrective pattern which is coming to an end. Alright, something like this, and after that another pull to the upside could occur. Alright, so that much from the dollar index. Question is, in a broader perspective, what does this mean for us as investors in the markets? Because this is where this whole topic is going to get very interesting. Essentially, if we're taking a dollar long position, what we are doing is betting against the Fed. So we're betting against the Federal Reserve in its ability to further stimulate the economy in the US and to further keep the interest rates low. So this is basically what is going on here. So this kind of development could signal us that actually we are in the end phase or end game of the Fed policies. So the Fed could get into a trap where they potentially can't keep the interest rates at low levels anymore, and where they are limited with their QE programs. Okay, so in what scenario would this happen? So this would actually happen if there's some sort of inflation. And as you know, many asset managers this year are actually expecting inflation to be kicking in and to start increasing. Why is that? Because we finished now the corona crisis and economies will open up again, and a lot of people did save during the corona crisis because they couldn't go outside, they couldn't spend anything, and so they have a lot of money piled up, and all of this money will come back into the economic machine, and therefore we should see some inflation kicking in very quickly. And this of course would limit the playing field of the Federal Reserve. And here is the big irony about this. If we're thinking about the US dollar, about the DXY, we would expect that with inflation, the DXY should go down. However, because this whole play is going on with the Fed, and what is actually priced in the DXY, why it is going down is because it is expected that the Fed is continuing to operate with very low interest rates and is continuing to stimulate. So all of this is priced in. However, if this expectation will change because the playing field of the Fed is narrowing, that would actually mean the DXY will go up. So it's basically counterintuitive of what we would be thinking if we're thinking about inflation. So basically in this case, inflation would mean the dollar would get stronger. Alright, so this is what I'm actually seeing when I'm looking at this chart, and these are my thoughts behind this. Of course, I could be totally wrong. This is my subjective research about this. Alright, so basically if the Fed is failing in its policies, the dollar should be strengthening, and therefore what would happen in the intramarket analysis? This is a very interesting point and we will explore this question further. First of all, you should notice if we have dollar strengthening, and this dollar strengthening happening at a fast rate, like here you can see it, or also here, etc. What normally was going on with the markets is a corrective phase. Alright, so here we can see the 2008 crash, here 2011 there was a flash crash, etc. And also here, if we're looking late 2014 and in 2015, we can also see a corrective structure in the market. After this, of course, Trump came and there was stimulating going on again, especially in 2017, and there the dollar came down, the Fed was stimulating again, and the economy was booming and the stock market went up again. So basically, if the dollar is increasing in a fast manner, that is not very bullish for the stock market. All right, but take that with a grain of salt, because this is not a one-on-one correlation. So what we want to do now, we want to look at inflation expectation. This will be very important this year and will be a key. So we can look at different inflation expectation vehicles like the ETFs. We have the ProShare Trust Inflation Expectation, but there are also different kinds with the 10-year, the 2-year, etc., etc. I will just take this one right now. And also here we can see it's definitely on the rise. And what this means is that we are expecting more and more inflation to come into the markets in the future. And again, inflation means that the playing field of the Fed is narrowing. All right, so keep an eye on this one. You can see it's in a firm uptrend. Should it continue up during this year, you should know that the playing field of the Fed is getting smaller. All right, here we want to look at the current inflation rate. We can see it's still kind of low. It has been going up. We can see here the deflationary shock with the coronavirus, and then it has been going up again. And the next reading will actually be next week, so you should keep an eye on that one, and it should be around 1.5%, something like that. If it goes up quicker than expected, then again, I'm expecting the dollar actually to go up, to strengthen, and narrowing the playing field of the Fed. You can actually take a look if this analysis is correct. Should you get a reading here that is higher than what was expected, definitely take a look at what is happening to the dollar at that moment, all right, to see if this assumption is correct or not. All right, another thing we want to look at is here. It's a statistic about the inflation rate, US inflation rate, and we do have some targets here for the future, and we can definitely see it is expected that there will be some kind of stronger inflation coming. Of course, this should be the case in 2021, since economies are opening up again, and many people have some money saved on the sideline because they could simply not leave their house. All right, so it is expected that inflation will go up to 2.77%, and that would actually mean, if this really would happen, that the playing field of the Fed is narrowing fast, right? Because if we get inflation over 2.5%, this is actually kind of the boundary for the Fed where they cannot intervene in the markets that much anymore. All right, if we go out over 2.5%, basically they will step back and say, okay, we don't want to risk like runaway inflation or something. So at that point, you can expect that the Fed is not able to, lower interest rates any longer, and maybe even has to raise the interest rates. All right, and if they raise the interest rate, that of course would be the end game of this whole game that has been going on here for years, and that would be bearish for the markets. All right, so keep an eye on that one. We are expecting like 2.77% in 2021. If this should really come into fruition, the playing field for the Fed would be basically not existing anymore. Should we even go higher than this, like if you would go to 3% or something like that, I'm expecting that the markets will turn to the downside, okay? Because the Fed cannot stabilize the markets anymore like they have done in all the years before. All right, so definitely take a look here what is going on here, and keep in mind at the moment we're still at the low level, 1.4%, something like that. If we should continue, of course, to be at low levels, and if we should not go at this boundary around 2.5, then of course that would still be bullish for the markets, right? All right, next we want to look at gold and silver probably, and then at the indices. All right, so we have opened up now the chart of gold, and this is again the monthly picture, and here something very interesting is going on. So gold actually might be topping out, all right? And again, this is counterintuitive of what many investors are expecting. Many investors at this point actually expect the gold price to rise and rise and rise because they all are expecting inflation to come. However, like I told you, this inflation is probably playing out exactly the opposite of what we are expecting. So actually dollar strength and not dollar weakness. So Key level here is this level of 1750 around here. If we should take out this low point here, then I'm expecting the gold price to roll over to the downside quite rapidly, and the scenario of inflation should be playing out in this case. However, at this moment it could also be that we're stabilizing here, so around this 1750. Should we stabilize here, then actually gold can go up again to test the 2000 mark, and then actually everything would still be looking good here and still bullish. But this here, like I said, is the trigger point. Okay, so definitely put a price alarm around this 1750, and this will be the key level. And actually, like I told you, it could be that a bigger top is playing out here. All right, next we want to look at silver. We kind of have like a similar scenario here. So silver actually could also be topping out. Okay, so we can take like measurements here. We're seeing that we're around the 50 area, and my initial target for silver was actually about around here, like the 35, 36 level. Maybe it will still come. However, we need to see how this monthly candle is playing out. All right, if this monthly candle comes in weak, we still have some time to pull up. Of course, the month is not over, but if it comes in weak like it looks now, then I'm expecting actually a bigger top to come here, and then the silver price could actually go down again. That would mean dollar strength like we have seen in the DXY. All right, however, this is still going on. It's too early to call, so I would just observe it at the moment. It could also be stabilizing and go up, and this target of 35 could actually still be in the cards. Okay, all right, so the last thing we want to look at is, of course, the stock market. We're taking a look at the S&P 500, and this market could top out and should top out if dollar strength would, manifest itself. So definitely take a look at what's going on with DXY. If the dollar strength is kicking in, then like I said, I'm expecting this market to come to the downside big times, because the bubble could finally burst, because everybody would see, okay, we have higher inflation, we have a strong dollar, so the playing field of the Fed is finished. Yeah. Okay, so in terms of Elliott waves, we can see there is like a 5-wave structure going on here, okay, which looks something like that. And of course here we also have a 1, 2, 3, 4, 5 internally, so inside the 3 that all matches up. We could also say that the point 4 is here. It doesn't really matter. However, I'm assuming that we are soon to be finished with this up move. It could extend a little bit more, of course. We could even go to the 4,000 level. Why not like do this kind of overshooting and then come down? However, I'm expecting a move to the downside coming quickly, and this of course will correlate with the dollar, which in that case should go up because inflation is on the rise. Okay, this is what could be going on here. If we should roll down here to the downside, we have a lot of room down. The first targets in the longer run would actually be here around the 3,200 level. Okay guys, for the last segment, so to speak, we want to look now at energy prices and maybe commodity prices, as well as interest rates, of course. Okay, so let's take a look here at the sectors. All right, so here we have our economic sectors within the US market. So, and we do want to look at energy, because energy is typically very interesting if we have an environment of inflation going on. All right, so let's take a look here. So this is the XLE. Me personally, this is of course not an investment advice at all. Please do your own research. I am long in this ETF at the moment, in this sector, because I do think we will get higher energy prices coming with the inflation. All right, so the key to understand this is, like I said, we do have dollar strength coming. All right, so we can see that, gold, silver, they're going down, which is counterintuitive of what we would expect in a inflationary environment, right? However, where we really can see if our assumption is correct or not, is if we're looking at other segments that should go up in price even if the dollar is increasing, okay? And that would typically be energy. So energy should get more expensive in a inflationary environment, even if the dollar is also, appreciating. And we can see this here. And this market actually, for me, has, formed kind of a bottom here, and potentially we're going up to these levels up here. So definitely take a look here. So what could be playing out is, like I said, I'm expecting actually the S&P, the broader market, to go down, so that we're potentially peaking either this year or next year. The timing, of course, is very difficult to say, but I would expect the indices to top out, and then it will be very interesting what is happening with the sector rotation, because only because the market is peaking and we're getting into a new cycle where a lot of stuff is going down doesn't mean, of course, everything is going down. This is not normally what is happening. There's always some sectors which are robust and which could even go up in a downturn environment, and I would actually expect this would be the energy sector. So I'm expecting actually this sector to be robust, either just go sideways or even increase. At the same time, I'm expecting other sectors, like for example the tech sector, which is very overheated, to go down in this inflationary environment, because this inflationary environment means that, like I said many times, the Fed playing field, so the policies of the Feds are limited and they cannot blow up these bubbles anymore like they have done all those years before. And of course, one of the sectors profiting the most of this Fed policy, these expansionary policies, was the tech sector. We have a startup mania there, we have an IPO mania there. The money, was always for free, and there are many companies which don't even have to be profitable at all. They can just borrow this money at low interest rates and finance their operations without making any profits. All right, this has been going on for years in the tech sector. Of course, this also brought in a tech boom, because we can finance research as much as we want because the money is free. So it had many advantages as well. But I think this party is actually coming to an end this year or next year. All right. And so I'm expecting actually that the energy sector to start outperforming the other sectors. So I would expect the energy sector to go up. All right. So this is my view on the energy sector. Alternatively, maybe it could also go sideways. So if other sectors tank, it could also outperform in a way where it just doesn't tank as much as the other ones. It just goes sideways. This could also be in play here. I don't see, however, this sector to fall down substantially anymore. I don't think so. I think the down movement has finished here, and either we are going sideways here or we will go up. All right, and keep in mind the energy sector is also high dividends. We can get a lot of dividends here, like for example Chevron is a heavyweight in this XLE, and so from a dividend perspective, this is also a nice investment. All right, so now let's take a look also in terms of Elliott waves. I'm expecting a three-wave corrective structure to have finished around this level down here, and we can also look in terms of Fibonacci if our targets have been reached. And we can also see they have been reached nicely with this 100 to 123 extension. All right, so this market looks for me like it's bottoming out, and in the next couple of years, this is of course a long-term play. This is like a monthly picture here, so this will be for the next 5 years. I'm expecting this sector to go sideways or even up, right? And also, like I said, nice dividends to collect here. All right, so much for the energy sector. We do want to compare this with, for example, the tech sector or other things. Okay, and there we have the XLK. This is the technology sector, and we can see this sector has been absolutely crushing it, only going up, 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 up. And this, of course, is due to the Fed policy of very, loose money and very cheap credit. Okay, let's take a look now, however, at targets. So we do want to measure from here. This is the .com bubble, and we want to kind of extend this move upwards, and we can see we are at a key level here, which is the 2.236. This will be very interesting. So this month of February is key, because either we are closing this month green and we are going above this candle, that would give us room even more to the upside, meaning the Fed policies will stay in place and we will go up more. Next target would be the 2.61. That of course could be. However, taking a look at the last candle, it's kind of like a spinning top, and so I have my doubts that actually we will just take this last candle, you know, from January out, you know. I have my doubts there, and so we need to see what happens with February. This candle of course has not been closed, so it could get pushed down again, and if it should get pushed down and if it should get red, all right, if February turns around, which I'm thinking there is a good possibility here, then I'm expecting this move actually to be over. And that would again mean the Fed policies have come to an end, and then we should turn down. First target would be here, of course, and the longer term target could be even down here, something like that. So that would actually mean a bigger crash potentially coming here in the tech sector. And again, from the cycle perspective, this just means that, you know, the Fed cycle has finally ended. What we can also do is take a look at RSI reading here, and we can definitely observe a divergence going on here. So this market, you know, it's not very surprising, it's very overbought due to the Fed policies. We have new highs here, but we don't see this in the RSI reading, and we are constantly between 70 and 80. So it's very overbought, and a correction, you know, would be very natural in this market. Okay, so this we can observe, and further we can take targets from here. Also, we can see here we're just shy beneath the 200 level here. So also there is a target area up here. Just taking a look at this swing, which has been taken to the upside. All right, so that much for this. And also we can do things like Elliott wave counting again. So we want to look at the motive wave, which is here with the 1, 2. Then we have a 1, 2, 3, 4, 5. So meaning the 3 has finished here, and there's an internal 5-way structure going on here. 3, 4, and the last wave 5, which might even extend a little bit more higher, but I'm expecting that there is not that much upside anymore, and actually we should reverse maybe this year or next year. Keep in mind, these are monthly charts, so everything I'm talking about right now will not happen immediately. It will take a lot of time because these are monthly pictures, right? So these are plays for the next couple of years. Okay, so that much for the tech sector. So of course, a play you could play if you want to do a long short portfolio, which I don't do. I'm not a fan of this kind of approach, but I know a lot of hedge funds do this approach, and yeah, like you could see in the recent development with GameStop and AMC, this approach can very much backfire in your face. So there is this kind of you know, idea behind long short, that you always go one sector long, one sector short, or one stock long, one stock short, to, you know, be beta neutral, so to, you know, take out your risk out of the market, which of course is a valid idea, but in the praxis I think it's kind of, yeah, you're kind of like manipulating yourself, because there's always risk in the market, and you can try to think you don't have directional risk anymore, but you know, you saw what happened with the hedge funds. Something unexpected happens, like a short squeeze in GME or AMC, and they're screwed, right? So the risk is still there, whatever. Okay, but if you want to do long short, of course, one idea would be to short the tech sector and go long the energy sector, for example. All right, you could also do this with other sectors, of course, if the tech sector is too crazy for you, because it is very much just going up like bubble style, right? So potentially very difficult to short it. You could also search out another kind of sector and short that one and go energy long. However, like I said, I'm not a fan of long short, so I just do long. I don't care about short. I don't like shorting. I think it's awful and you always get in trouble with shorting. So I just do long, right? This you can also do. For example, for me, my personal setup is just energy sector long, for example. All right, so that much for the sectors. So last thing we want to look into now are the interest rates. So we will do this. So for this, we want to look at the 10-year first. All right, and we can observe here, monthly picture, we were very much oversold here on the RSI and came up here in the normal territory again. And like I said, this could be a point where the interest rates would turn around. And why is that actually happening? Why are the interest rates going up? This again is due to expected inflation coming to the markets. So if inflation is going to rise more quickly and more higher than we were pricing in previously, if there's some kind of inflationary shock potentially coming, this should be also reflected in the interest rates, because the interest rates should be above the inflation level. Otherwise, we're losing money. So the interest rates should go up because inflation is go up, and so the real interest rate should still be kind of profitable for us as investors. Otherwise, we would not borrow the government any money, right? So as inflation goes up, also the interest rates on the bonds should go up, of course, and we can exactly see this right here. We can see some kind of bottom potentially forming, and we also can see this thing has been going down for many years, and I'm very curious of this new development which is happening here. This could also signal to us that maybe the Fed policies at this point are limited. All right, last thing we want to do, compare the US 10-year and the US 2-year. And also we can see here, this is a steepener going on in the interest rates. So they're going up. This should actually be good for financials. However, I don't do any positions right now in the financial sectors, in the banks, etc. This steepener should be good for them. But I would be cautious, because I do think because of coronavirus, a lot of companies will struggle, especially retailers, and a lot of credits might not get paid back, and this would of course hurt the banks. Therefore, even the interest rate steepener is going on, I don't do anything in the financial sector. I rather think actually the financial sector could also turn down. Okay, but we can observe a steepener here, and like you can see it here from my previous notes, why would we look at this chart and compare 10-year versus 2-year? We do this because it's a very good indicator to spot bubbles in the markets, okay? So basically what it means, it kind of shows us the firing power of the Fed, which normally extinguishes down here in an inverted territory. So the red line is the zero line, and that means at this point short-term interest rates would be higher than longer-term interest rates, and that doesn't make any sense in a normal economic environment. We don't lend out money to anyone and then expect in 10 years to collect less interest than in 2 years, right? But exactly this is what is happening here in those kind of territories where there is a big inversion. And here you can see it, we were just going into this territory, but then completely turned around because Corona hit. And so question is this a signal that the stock market bubble is bursting or not? And here the pictures to me is too unclear. I can't call it. If we have something like this, if we have an inverted territory, what does it normally mean? It normally means like 1 year to 1.5 more years, and then we have some sort of crash coming. All right, and normally the crash actually happens when we get out of this inverted territory, right? If we come up here again. So it has always been a reliable indicator. We can see it here. For example, we did get the signal like in late 2006 and 2007, and like 1 year later we came out here around latter stages of 2007, and then in 2008 somewhere up here the crash hit, right? So the housing bubble. And actually here it's difficult to say because we weren't very extensively in this inverted territory, but we could actually make the point that we did have the inversion. It was here, briefly, and then we should at that point add on 1 year or 1.5 more years. So this happened like in August, September 2019, and then plus 1.5 more years. So that would bring us to where we are actually right now, right, in 2021. And that actually could mean that this was a valid signal and there is a crash coming, right? So we need to see about that. However, this signal was very briefly and very quickly. So for me, I don't know if it's really a valid signal. So this chart unfortunately is a little bit messy, all right? So, but you can keep this, of course, in mind that there is the possibility here that this down here has been a valid signal. All right, guys, with that being said, that was it for now. That was everything I wanted to show you and discuss about. I wish you, of course, a wonderful weekend and much success in the new trading week. Take care and see you in the next video. Bye bye.